So this is how not to do the buy, borrow, die strategy. Unfortunately, 90% of people think this is how the strategy is done. And this is commonly how a wealth manager might put a client's portfolio into something similar to this, maybe more complicated, but it achieves the same thing. Low volatility, high dividend growth. Problem is with high dividends is they are a taxable event, and the whole point of buy, borrow, die is to avoid a taxable event. You see, a margin loan or a security-backed line of credit or a Lombard loan, they're all the same thing, but they do not trigger a taxable event. In order for the strategy to work, you need the portfolio to have capital growth, and high income portfolios just do not achieve that. So here I have on the risk terminal a standard portfolio with an all-world fund, AT&T high dividend, real estate high dividend, covered call ETF from JP Morgan high dividend. The portfolio has a weighted beta of 0.53. It's a $2 million portfolio. It's generating about 100 grand a year in income, taxable income. And I've taken out a margin loan of 400k. Yeah, minus 400k. The problem with this, there's a lot of problems with this. The challenge we have is look at the actual capital growth over a 10-year period. See, our debt costs are slowly going up, and our portfolio is not outgrowing the debt. That defeats the entire purpose of the strategy. You see, let's zoom in on this. Now, also something else you must keep in mind. The strategy, this portfolio has a low beta, yeah, and everyone's obsessed with the low beta. It's an emotional pacifier for the client. But in a true black swan event, that beta figure kind of goes out of the window. Remember COVID? COVID, the All World Fund, actually crashed more than the NASDAQ. 34% your All World Fund, and the NASDAQ crashed 28%. And we're not getting the capital growth that we need. Look, that's over 5 years. It's a 50% growth. That is not enough to outperform the cost of the debt. You see? So we're still getting volatility anyway in a black swan, and we're not getting the growth that we could be getting during a bull market. So this is the actual backwards way to do the strategy. The problem people have is they look at the dividend yield, and that's sort of what seduces them into the strategy. But look here, right, so these are the actual calculated total blend. We're getting $92,000 on annual dividend. I mean, really, the blended yield is the same as a US Treasury bond. So we're still getting volatility for the same yield we can get for the risk-free rate. Do you see how backwards the strategy actually is when you look at it over the 10 years period? So the loan to value, we borrowed 20% of the portfolio, and now it's creeping up by year 10. Obviously, we're not going to get margin called on this portfolio, but we can still structure the same strategy where we get the capital growth where the debt is shrinking and the portfolio grows with enough protection from any risk of volatility, market crashes. Yeah, there's ways that we structure it. We add a ballast to the portfolio. We add defensive stocks to the portfolio or treasury bills, but we still have enough velocity to grow the portfolio. But unfortunately, what we've done here, this is a textbook strategy where we have high income, no growth. You cannot do the buy, borrow, die strategy without the growth. You're trying to copy a billionaire's strategy who these people own big tech companies. So they've got enough growth to outperform any debt that they want to take on the portfolio. You can't copy the strategy using dividends. And it's a psychology view. I've talked about dividends before. It's a total pacifier. If you have $100 in a wallet and you take $4 out of the wallet, you don't have $104. You still have $100. But investors seem to think these high dividend paying stocks and equities, the money just comes out of thin air. They're just giving you your money back and triggering a taxable event. So this is how you do not do the strategy. And you're going to trigger a silent margin call eventually. And you've got so much opportunity cost in this portfolio. So after 10, 15 years of all the growth you could have had, you've settled for an annual income, and you're not even able to borrow anymore because the portfolio doesn't grow. So you've borrowed a 400k loan once, and you can't borrow ever again because the portfolio hasn't grown any further. In fact, it's going the opposite. After 10 years, this loan to value is supposed to be shrinking, but it's going the opposite way. Yes, this is why we don't chase dividends. Family offices and elite level investors do not chase after a dividend. It just eliminates the strategy entirely, and you're leaving money on the table, triggering taxes, all for this getting a yield that you could get from a US Treasury bond. The way the strategy should be done correctly, where you can actually continue to borrow more as time goes on, is high growth. At least you can get 70%, sometimes 80% of high growth ETFs or individual big tech monopolies if you like to do that. Because you need to surpass the hurdle rate of 6.5 to 7% of monetary debasement and the cost of the loan. And what happens by year 10 is that loan to value would drop to, say, 10%, depending on how much growth you have in the portfolio, and you can continue to borrow more money from the portfolio to fund lifestyle. And the debt shrinks over time. You see, that's why the growth is important. That's why family offices and the billionaires can do the strategy, because they have the growth. But to get the growth, you need the volatility. And the volatility is the price of admission. You can't escape it. If you want to do the strategy, you must accept the volatility. You must become emotionally immune to it. So you can't play the game that the billionaires are playing if you're not willing to go through the wild swings in the market. And if we keep our borrowing level low enough and enough protection in the portfolio, you will not get margin called. There's no way. But people that are not familiar with the strategy or have enough experience with their brokerage account and borrowing in margin correctly, it takes a lot of education and learning points to break through that education barrier. But there it's right there. The diversification is almost an illusion, because look at COVID. 34% crash in the All World Fund. NASDAQ crashed 28%. So in a true black swan, the weighted beta kind of goes out the window, and that's where the risk management comes into play. So there you have it. This is how you do not do buy, borrow, die, and avoid the silent margin call and the net asset value decay, the structural decay.